everyone, welcome back to the channel. In today's session, we are going to break down a market behavior that often confuses even experienced traders and investors. So, why do foreign institutional investors, or we call them as FIIs, sometimes sell progressively in the futures market while buying in the cash segment? On Friday, we observed that FIs were buyers in the cash market but sellers in the futures market. So, what does this tell us about their market outlook? And that's exactly what we're going to break down in today's video. So, at first glance, it might seem contradictory. One side is short, the other side is long. So, what's really going on behind the scenes? And you must be wondering, is it a hedge, a market trap, or a signal or something bigger? And more importantly, what should you do as a trader or investor when you see this happening? Should you panic? Should you follow them? Or should you dig deeper and spot opportunities others miss? To make it even more actionable, I will walk you through a real historical example, a time when FIs used the exact strategy, and what followed in the market was quite revealing. So, whether you are a day trader, swing trader, or a long term investor, understanding this pattern can give you a serious edge. So, make sure you stick around till the end because once you see the logic behind this, you will never look at FI data the same way again. So, let's jump in. All right, let's now dive deeper into what it really means when FIs are selling in the futures market but buying in the cash or spot market. So, now to many people, this might look confusing. You might think, wait, why are they buying in one place and selling in another? Aren't they contradicting themselves? But actually, this is a very strategic move, and there are a few smart reasons why they do this. When FIs are buying in the cash market, it means they're purchasing actual shares of companies like Infosys, Reliance, or HDFC Bank. These are real holdings. It's not speculation, and they're saying, we believe in these companies and want to invest in them for the long term. So, this part of the move reflects confidence in the Indian market, especially in strong sectors or specific stocks. At the same time, FIs sell future contracts, usually index futures like Nifty or Bank Nifty, and you must be wondering why. Because this allows them to hedge their exposure. So they're essentially saying, we are confident about these stocks individually, but we are cautious about the overall market. Maybe because of global uncertainty, upcoming events like RBI policy, or geopolitical risk. So, if the market corrects in the short term, their long cash positions might lose value, but their short futures position would gain, balancing out their losses. It's like wearing a seatbelt while driving. You're still moving forward in a bullish way, but you're prepared if things go wrong. But let's understand why they do it. So, FIs often invest in the cash market, meaning they're actually buying and holding real stocks. But at the same time, they may want to protect themselves from short term volatility or uncertainty, especially if there is an event coming up, like a Fed meeting, election, or even monthly expiry. So, what do they do? They sell index futures like Nifty or Bank Nifty futures to hedge their long positions. Think of it like this. They're saying, I believe in the market long term, but just in case we get a dip or correction in the short term, I am fully covered. So, this is a classic defensive move. It's like wearing a helmet while riding. You're still moving forward, but with the protection. So, let's say FIIs have invested in Infosys, HDFC Bank, and Maruti Suzuki, strong, fundamentally sound companies they believe in for the long term. They expect good returns over the next few months. But there is upcoming RBI policy announcement and volatility is expected in the next 1 to 2 weeks. So what do? They keep their long positions in these individual stocks, but to protect their portfolio against sudden market-wide correction, they sell Nifty futures, let's say at 23,800. Now, if the market falls short term, their Nifty short position will make money Even if the individual stocks dip temporarily, they are hedged. They are not bearish on the stocks, they are just defending the portfolio from index wide risk. Think of it like buying insurance. So, still driving forward, but with a helmet on. Another interpretation is what I call cautious optimism. FIs might be seeing strength in specific sectors or stocks, maybe IT, pharma, or auto. So they start buying them in the cash market, but at the same time, they might be skeptical about the broader market index, say Nifty or Sensex. So this shows that they are not fully bearish. They're just playing smart by picking winners while guarding against index wide risk. So now let's say FIs are very bullish on the IT sector, which is showing strength. They buy TCS, Infosys, or Wipro, but they look at the broader Nifty index and see weakness in sectors like PSU banks or real estate. They think, yes, IT is strong, but the index as a whole might struggle. So they buy individual IT stocks but sell Nifty futures. This way, if IT outperforms, they still win. If the Nifty falls due to weak PSU or auto, the short Nifty hedge protects them. This is called sector rotation or stock specific conviction, and it is a sign of cautious optimism. So they're bullish on parts of the market, but not the entire market. So sometimes this move has nothing to do with bullish or bearish sentiment. It's simply about taking advantage of price differences between the cash and the future markets. So let me explain what I mean by this. If a stock or index futures is trading at a premium compared to the spot price, FIs might sell the future and buy the stock in cash to lock in a small profit when the prices eventually converge. This is called cash future arbitrage. It is a short term technical play, usually done by institutions with big volumes and low transaction cost. Arbitrage just means buying low in one place and selling high in another to make a risk-free profit. Now in the stock market, this can happen between, the cash market, also we call as a spot market, where you buy and sell actual shares, and the future markets, where you trade contracts and represent those shares but settle at a future date. So let's go through an example. Let's say Reliance Industries is trading at, suppose, say 2,500 in the cash market, but the Reliance futures contract is trading at rupees 2,520, which is 20 rupees higher. Now, both these prices will eventually converge by the time the futures contract expires, say at the end of the month. So, here is what a big player like an FI would do. They would buy Reliance in the cash market at 2,500 rupees and sell Reliance futures at 2,520 rupees. So, now what happens? When expiry comes, the price of the future will drop to match the cash price or vice versa. And this gives the FI a guaranteed 20 rupees profit per share. So this is called cash future arbitrage. It's not about predicting direction. They don't care if the market goes up or down. They're just locking in the price difference with a huge volume. And you must be wondering why only big institutions do this. Because the profit per trade is very small, like 5 rupees, 10 rupees, or 20 rupees per share. But if you do it with lakhs of shares, that small difference becomes a big profit. And also, they have lower brokerage, better infrastructure, and fast execution, which gives them an edge in doing these technical trades. So, let me walk you through a real life example where this exact situation happened and how it played out in the market. So, we are talking about October 2010. During this time, FIs were heavily buying stocks in the cash market, especially in strong sectors like banking, IT, and infra. This means they had long term conviction. They were clearly bullish on India's growth story and were adding quality companies to their portfolios. But here's a twist. At the same time, they were selling large quantities in the future market, especially index futures like Nifty futures. So you might ask, if they were bullish and buying in cash, why were they selling the futures? And here is the answer, and that is cost of carry. And you must be wondering, like, what's the cost of carry? It's basically the extra cost involved in holding a futures position. So in October 2010, the cost of carry became expensive, meaning the futures were trading at a big premium to the cash market. So let's say Nifty cash was at 6,000 and Nifty futures was at 6,050 rupees. So that 50 rupees difference is the cost of carry. So when the difference becomes too wide, FIs often prefer to book profits in the futures and reduce risk, especially near monthly expiry. So what do they do is held on to their long-term cash investment, but sold futures to lock in short-term gains or protect against their expiry-related volatility. So what happened next? After a bit of short-term choppiness and volatility, the market eventually moved higher because the cash market buying was strong. That buying represented real conviction, and once expiry was over and futures positions were rolled over, the market picked up momentum again. All right. So, what should you do when you spot this behavior? I will split this section into two parts because I want to cover what it means from the angle of both traders and investors. So, let's start from the traders first. As a trader, your focus is often on short-term price action, volatility, and quick moves, right? So here is what you need to keep in mind when you spot FIs buying in cash but selling in futures. So when you see this behavior, it often signals short-term uncertainty. While FIs may be confident in specific stocks, the futures market is usually reflecting some short-term market anxiety, potentially from expiries or global news or domestic events. So be prepared for sharp fluctuations in the market. This means you may see a lot of ups and downs movement in the index and specific stocks or over the next few days. If you're trading with high leverage, this volatility could be a risk. You don't want to get caught in sudden price movements that could quickly wipe out your gains or worse, your entire capital. So, leverage magnifies your risk, and in this kind of uncertain market behavior, it's best to scale back and focus on lower leverage or non leveraged positions. In such scenarios, you may see liquidity sweeps, large orders that push the price down, false breakouts, and sharp reversals in the price. This happens because institutional players often try to shake out the weaker retail investors. Stay alert for those moves. If you spot a sharp price drop, make sure it's not a fake breakdown where the price suddenly dips only to reverse quickly back up. The market will likely experience a lot of choppy price action, so you need to be quick. Use tight stop losses to protect your positions, especially if you're trading intraday or with short term moves. Focus on quick trades that allow you to get in and out of the market before any major reversals happen. Keep your risk to reward ratio favorable by not holding on too long. So, as an investor, let me talk about from that perspective. So, you're typically looking at long term trends, right? And holding positions for months or years. And here is how you can approach the market when you see this behavior. So if you see FIs buying in the cash market, this is a good sign for long-term growth. It means they believe in the long-term prospects of the quality stocks or sectors like IT, banking, or pharma. For instance, if FIs are buying stocks like HDFC Bank or TCS, and you are done with your research, trust your analysis. Don't get distracted by short-term market moves. And remember, the key here is the cash market buying. FIs are still confident about the underlying stocks and market. This isn't an indication that the market is about to crash. The cash market represents a real conviction. And if they are continuing to accumulate stocks, this shows confidence in India's long term growth. So, short term futures selling may cause a temporary dip in the market. Do not panic. This is often just short term volatility and it does not reflect a change in the long term fundamentals of your holdings. In fact, this can sometimes be an opportunity to buy more shares of your favorite stocks at a discount. FIs may be buying specific stocks in the cash market. Look for these stocks and do your own research on these fundamentals. You will want to identify high quality stocks where accumulation is happening, meaning institutions and FIs are actively adding positions. These stocks are more likely to benefit when the market moves higher over the long time. Always remember, short term fear is often used to shake out weak hands, people who panic and sell out their stocks. Before a bigger rally, the market often goes through periods of uncertainty to clear out those weak hands, creating better entry points for long term investors. So, an investor, you should keep an eye on the bigger picture and not get swayed by short term market movements. So the next time you see headlines saying FIs are selling in futures but buying in cash, you will know it's not just about panic or bearishness. It's a strategic move that could actually signal hidden strength in the market. So when FIs engage in this kind of activity, they're not blindly reacting to the market. They're being calculated, possibly looking for short-term protection while maintaining long-term bullishness. The fact that they are still buying in the cash market, despite selling futures, shows that they believe in long-term market strength. It's a sign of conviction, not panic. So, do let me know in the comments, have you ever noticed this pattern before? And how do you plan to use it in your trading or investing journey? If you found this video helpful, make sure to like, share, and subscribe to the channel and hit the bell icon so you never miss a powerful trading insight. And thank you for watching, and I'll see you in the next one. Until then, happy trading.